Hi, in this video we'll introduce a new type of derivative, which is the option, and we'll deal with the call options first. So options give the investor the right or the option to exercise this contract, but not the obligation to exercise it. So the investor could choose to exercise the option or not, based on the situation as they see fit. So let's take a look at the basics of the options themselves. So basically, they will give you the option or the right to buy or to sell at a pre-specified price and at a pre-specified date. Okay, which is very similar to our forward contract. We will still have a strike price in this case, which is your pre-specified price at which you will exercise this option for the underlying asset. And we'll use ST to indicate the price of the underlying asset, and K will be the strike price, and T will be our maturity. Okay? And for a call option, the investor is given the right or the option to purchase or to buy an underlying asset at the strike price at maturity. Okay, so the call options are the options to buy. And we'll deal with the simple or the most straightforward type of call options first. So there are different types of call options. Namely, some of these options can be exercised earlier before their maturity, and these are called the American options. Okay, we'll use this here, the American options. And we'll be dealing with the European options, which is you can only exercise your options at the time of maturity. But for American options, you can exercise it earlier as long as the investors see fit. Okay, and the call options, again, they give you the option to buy or the right to buy the underlying asset at the pre-specified price, which is our strike price. And for now, we'll be dealing with stocks as the underlying assets, and they will be non-dividend paying stocks. Okay, they'll be non-dividend paying, and we'll be relaxing these assumptions as we go on, but for the time being, let's take a look at the most vanilla type of our call options. Okay, so what will be our payoffs for the options, for the call options of these based on these assumptions? Okay, so the payoff for buying an option or holding a call option is that we are hoping that the spot price of our underlying asset is going to be greater or exceed our strike price, which is very similar to our forward contract. We make a profit, or we can make a positive payoff whenever our ST or the price of our underlying is higher than our strike price. Okay, so for every dollar or every pound that is higher than a strike price, we make it as a profit. Okay, but what about the other way? So if the ST in this case, or the price of the underlying asset, is lower than our strike price, the investor will not actually exercise this call option. Why is this the case? Because they'll have to buy the underlying asset at a higher price compared to the market price. So there's no reason for them to exercise it, because they will make a loss. Okay, they will only exercise it if the strike price is lower than the spot price of the underlying asset, so that they can make a profit out of it. Okay, we can express this on the diagram. So if you buy a call option, or you go long with the option, so we have talked about this before. If you go long, it means you purchase something, and if you go short, it means you sell something. Okay, so let's first deal with the long call position here. So as an investor, I will never exercise my call option if the ST or the spot price is lower than the strike price, because now I have to pay more than the market price. So any price before the strike price, I will never exercise it, and hence I'll get zero payoff. But any price for our underlying asset that is higher than our strike price, I will be inclined to exercise my option for here. And since we're only buying just one unit of our option, so every dollar or every pound of our excessive price, or this the price that is higher than the strike price will make the exact amount of our profit. So this will be a 45-degree line upwards, and this will be 45-degree. Okay, so what happens if we buy more than one options in this case? So for example, if we buy let's say 2 options at the same time with the same strike price, with the same underlying asset, then the slope will be doubled. Okay, the slope will be doubled, and that's it. Right? So for someone to, or for an investor to go long with the call, someone else must be able to sell them this call option. So there will be a seller of the call option, and there will be a short position in this case. So what would be the payoff for a short position in this case? We're just considering the intrinsic payoff, and we're not considering net payoff yet. Okay, so naturally you will think this will be the mirror image, or you can think about the rotated image of this graph around the x-axis over here. So the payoff for the short position would be 45-degree line, but downwards in this case. Okay, and we can also express this in a mathematical way, which is the maximum, that's the long position, between 0 and st minus k. Okay, you can compare this payoff with our forward contracts. With the forward contracts, we're only having this thing, right? So st minus k will be our payoff for the forward contract, but here, since we're sort of protected from the downside because we don't have to exercise it, compared to the forward, we're obligated to carry out the contract, whether the spot price is higher or lower than our strike price. But for the options, because we're given the option and the right to exercise it or not, we can sort of cap our losses here at 0. Okay, so this will be the payoff for a long position, and if it's a short position, then you can just put a minus sign before this, the minus of this, st minus k. Okay, so this will be our basics for the call options. We will add on other stuff onto it, but for now, you should be able to understand the payoff structure of a single European style and also non-dividend paying underlying asset as the underlying asset call option, and the payoff of its call option, and how to write its diagram in this case. And also remember, the payoff in a mathematical form will be the maximum between 0 and st minus k. And I'll see you in the next video.